AMD just reported the kind of quarter that should have sent an AI stock to the moon. Revenue reached a record $11.5 billion. It jumped 50% in 1 year. Data center revenue more than doubled. Adjusted earnings beat expectations, and AMD guided the next quarter above Wall Street's consensus. Then the stock fell about 9% after hours. Think about that for a moment. AMD did not miss. It did not warn that AI demand was collapsing. It did not delay its next generation of chips. The company delivered record revenue, record profitability, and one of the strongest growth forecasts in the semiconductor industry. Yet within minutes, tens of billions of dollars in market value were at risk of disappearing. That is not just an AMD story, it is the clearest sign yet of the AI bubble's weakest link. The weakness is not that companies have stopped buying AI chips. They have not. The weakness is that investors have already priced in a future so enormous that even spectacular growth can feel disappointing. When a company grows 50%, beats the published estimates, and still gets punished, the market is telling you that the official expectations were never the real expectations. Wall Street wanted more than a beat. It wanted a detonation. And what AMD revealed is far more interesting than a simple earnings headline. The report shows two different AI booms happening inside the same company. One is already producing record revenue today. The other is built around giant promises for late 2026and 2027. One is powered heavily by server CPUs. The other depends on AMD proving that its Instinct GPUs and Helios systems can become a true alternative to Nvidia. Those two stories look similar from a distance. They are not the same. So the real question is not whether AMD had a good quarter. It had an excellent quarter. The question is why an excellent quarter was not enough, and what that tells us about every AI stock whose valuation depends on years of perfect execution. Start with the numbers. AMD reported second quarter revenue of $10.10 billion, up 50% from 1 year earlier and 13% from the previous quarter. Adjusted earnings were $1.60 per share, slightly above the consensus estimate of roughly $1.62. Adjusted operating income reached $10 billion, and the adjusted operating margin expanded to 20.7%. The most important figure was data center revenue. It reached a record $11 billion, up 107% year-over-year and 16%. Sequentially, data center now represents 50.8% of AMD's total revenue, compared with 40.2% a year ago. In other words, AMD is no longer mainly a PC chip company trying to participate in AI. The data center has become the center of the entire business. On the surface, this is exactly what the bulls wanted. EPYC server processor sales increased more than 70%. Instinct accelerator sales more than doubled. Cloud and enterprise server sales each grew more than 70%, and AMD recorded its fifth consecutive quarter of record server CPU revenue. But here is the first detail that matters. AMD still reports EPYC CPUs and Instinct AI accelerators inside the same data center segment. We know that both grew strongly, but we do not know the exact dollar amount generated by Instinct GPUs in the quarter. That missing number is crucial because the market is not valuing AMD only for taking server CPU share from Intel. Investors are valuing it as the one company with a credible chance to challenge Nvidia in AI acceleration. A booming CPU business proves that data centers need more compute. It does not automatically prove that AMD is capturing a large share of the most valuable AI accelerator market. The distinction explains part of the violent reaction. AMD proved that its data center business is exploding. It did not provide the clean, separate GPU revenue figure that would let investors measure exactly how quickly the Nvidia alternative is scaling. Now look at the forecast. For the third quarter, AMD expects approximately $13 billion in revenue, plus or minus $300 million at the midpoint. That would be growth of 41% year-over-year and another 13% sequentially. It was also above the published consensus of roughly $12.5 billion. The company expects adjusted gross margin of about 56%. Again, those are powerful numbers, but the stock market was apparently positioned for something even larger. Some investors were looking for guidance closer to $6 billion because AMD shares had already rallied sharply into the report, and because the company's enormous customer announcements had pushed expectations far beyond the formal analyst consensus. This is how a bubble becomes dangerous without becoming fake. The underlying business can be real, the revenue can be real, the customers can be real, but the stock can still be vulnerable when investors quietly replace reasonable forecasts with fantasy, level whisper numbers. AMD closed the regular trading session up about 7%. After the earnings release, the shares fell roughly 9% from that close, wiping out the entire daytime gain and then some. The message was brutal. The market had already celebrated the future before AMD had a chance to report the present. And that brings us to Helios. Helios is AMD's rack Dan-scale AI platform. It combines Mi Wuxi Dan series GPUs, EPYC Venice CPUs, Pensando networking, and ROCm software in one integrated system. This matters because the AI competition is no longer just chip against chip. Nvidia sells an entire computing platform, including networking, software, developer tools, and complete rack systems. AMD cannot break Nvidia's dominance by offering a fast processor alone. It must offer an alternative ecosystem that can be installed, programmed, scaled, and maintained across thousands of accelerators. Management said Helios is now in production. Initial shipments are expected near the end of the third quarter, followed by a more meaningful ramp in the fourth quarter, and another step higher in the first quarter of 2024. Lisa Su said customer demand is tracking ahead of AMD's original forecast, particularly for inference workloads. The customer list is impressive. AMD has large, multi-generation relationships involving Meta and OpenAI. Anthropic plans to deploy up to 2 gigawatts of Mi Wuxi Jian series GPUs in Helios systems, with the first gigawatt beginning in the first half of 2024. Microsoft also plans to deploy Helios on Azure for frontier Jian model inference. These are not random companies testing a few chips in a laboratory. They are some of the largest buyers and builders of AI infrastructure in the world. Their participation gives AMD technical credibility and creates a believable path to tens of billions of dollars in future AI revenue. But a path is not the same as recognized revenue. During the call, management repeatedly described the sequence: a small beginning late in the third quarter, a larger step in the fourth quarter, another step in early 2024, and then a ramp through the year. Lisa Su reiterated that 1 gigawatt of deployment can represent double-digit billions of dollars in revenue. She also said the data center segment should more than double again in 2024, with data center AI growing well above 100%. That sounds extraordinary. It also reveals the second weak link. Much of the most valuable part of AMD's story has been moved 1 or 2 quarters into the future. The company must manufacture the chips, secure advanced packaging, obtain enough high DAN bandwidth memory, assemble the racks, improve early production yields, ship the systems, and match those shipments to data centers that have land, power, cooling, networking, and finished buildings ready to receive them. A customer can want 1 gigawatt of compute and still be unable to install 1 gigawatt on the original schedule. This is not a theoretical concern. Analysts on the earnings call repeatedly asked about data DAN center readiness, HBM supply, production yields, and how many customers would actually contribute revenue in the fourth quarter and first half of 2024. AMD said it has strong supply visibility and confidence in its targets, but management also acknowledged that Helios is an extremely complex product, that yields should improve over the first few quarters, and that the range of possible results depends partly on how quickly customers can bring new capacity online. In other words, demand may be enormous while revenue timing remains fragile. That fragility sits at the heart of the AI trade. The biggest AI deals are now measured in gigawatts, not merely in chips. A gigawatt is not an order that can be delivered to an office next week. It is an industrial project involving power plants, substations, cooling systems, memory suppliers, foundries, packaging facilities, network equipment, construction crews, permits, and billions of dollars in financing. Every link must work. If one link slips, the chips may still be sold eventually, but the revenue can move from one quarter to the next. For a normal company, that might be a minor delay. For an AI stock priced for constant acceleration, 1 quarter can feel like an eternity. There is also a margin problem hidden inside the growth story. AMD's adjusted gross margin rose to 50.6% in the second quarter, and management guided to the same level for the third. That is healthy. But AMD also said its rapidly growing data center AI business currently carries a gross margin slightly below the corporate average. This is important because the market often assumes that more AI revenue automatically means more profitable revenue. Early rack DAN scale deployments can be expensive. AMD is investing in silicon, networking, systems engineering, software, customer support, and production capacity. Research and development spending reached about $1 billion in the quarter, while total adjusted operating expenses increased 40% from a year earlier. Inventory also rose to approximately $1 billion as AMD prepared for strong data center demand. That inventory can become a powerful revenue engine if the ramp goes according to plan. It can become a warning sign if customers delay installations or if product transitions happen faster than expected. AMD generated $1 billion in operating cash from continuing operations and $1 billion in free cash flow. Those figures show that this is not a speculative company burning cash to chase a dream, but they also remind us that scaling an AI platform is capital-intensive, operationally difficult, and less magical than a product announcement makes it sound. The third weak link is software. AMD's hardware can be competitive on performance, memory capacity, and cost. Helios is designed to deliver strong inference throughput and better tokens per dollar. But Nvidia's deepest moat is not a single benchmark. It is CUDA, the software ecosystem that developers have used for years, combined with Nvidia's networking, libraries, tools, and installed base. AMD says ROCm has reached an inflection point. More than 3 million models can now run out of the box on AMD hardware. OpenZAN source contributions have increased more than tenfold in a year, and the new ROCmi platform uses coding agents to help developers port and optimize workloads. AMD is also Cogen optimizing software with major AI labs. That progress is meaningful. Yet software adoption cannot be measured only by the number of supported models. The real test is whether customers can move production workloads to AMD without creating costly engineering headaches. A chip may offer more memory or a lower price, but if developers spend months rewriting software, the apparent savings can disappear. This is why the first Helios deployments matter so much. They are not simply sales. They are public tests of whether AMD can operate at rack scale, deliver stable software, and give customers a reliable second ecosystem. If those deployments work, AMD gains more than revenue, it gains trust. If they stumble, Nvidia's moat becomes even stronger. The report also revealed an unexpected strength that complicates the bubble argument. Server CPUs are booming. AMD said cloud and enterprise EPYC sales each grew more than 70% customer demand. For the coming Venice generation is stronger than for any previous EPYC family. Server supply has been tight because demand rose faster than expected, and the company is adding wafer, packaging, substrate, and back-end end capacity. Management now expects server revenue to grow more than 80% year-over-year in the second half of 2024 and more than 70% for the full year 2025. This suggests that AI is not only creating demand for GPUs, agentic AI systems require CPUs to organize tasks, feed accelerators, manage data, and run the enormous amount of ordinary computing that surrounds every model. The more AI becomes part of real business workflows, the more general general-purpose compute may be required around it. That is evidence against the idea that the entire AI boom is empty. Real infrastructure is being built. Real workloads are spreading. AMD is gaining real share. But it is not evidence that every AI stock is correctly priced. The rest of AMD's business makes the same point. Client revenue rose 23% to $1 billion, helped by Ryzen demand and record mobile processor revenue. Embedded revenue increased 19% to $1 Gaming revenue, however, fell 31% to $1 as the console cycle weakened and high component costs pressured graphics demand. AMD is increasingly diversified, but the stock's premium depends on data center AI. PC growth can support the quarter. Embedded chips can support margins. EPYC can take share from Intel. None of those businesses alone can justify the most aggressive assumptions now attached to AMD's future. So, did this earnings report prove that the AI bubble is bursting? No. The actual business data says the opposite. Revenue-accelerated data center sales doubled. Instinct sales doubled. The next quarter forecast increased. Helios remains on schedule. Major customers are still building. What the report proved is that the valuation bubble can crack before the infrastructure boom ends. There is a difference between saying AI is useless and saying investors have become too impatient. There is a difference between saying demand is collapsing and saying the market expected more than any company could reasonably deliver in one quarter. AMD's 9% after Dan hours drop was not a verdict that AI is dead. It was a warning that perfection has become the minimum requirement. That is a dangerous standard. If 50% revenue growth is treated as disappointing, what happens when growth slows to 30%? If guidance above consensus triggers a sell-off, what happens when one customer delays a data center? If a company must exceed not only published estimates but also invisible whisper numbers, the stock can fall even while the business keeps improving. For the next 2 quarters, 5 signals matter first. Watch whether AMD begins providing more specific Instinct revenue information. Data center growth is impressive, but investors need to see how much comes from AI accelerators rather than EPYC CPUs. Second, watch the Helios shipment cadence. The end of the third quarter should be the beginning. The fourth quarter should be a clear step up. And early 2024 hold show that gigawatt scale programs are becoming invoices rather than announcements. Third, watch gross margin. If revenue accelerates while adjusted gross margin remains stuck at 50.6% or moves lower, the market may worry that AMD is buying share through aggressive pricing or absorbing expensive early ramp costs. If margin rises as volume scales, the platform strategy will look much stronger. Fourth, watch inventory, HBM supply, and production yields. Rising inventory is bullish when shipments follow. It becomes dangerous when deployments slip. Helios is complex, and complexity creates more points of failure. Fifth, watch the customers, not just AMD. Meta, Microsoft, OpenAI, Anthropic, Oracle, and other builders must continue converting capital and spending plans into powered data centers. AMD can execute perfectly and still be affected by electricity constraints, construction delays, financing conditions, or a decision by one large customer to slow spending. The bull case after this report is stronger at the business level. AMD has record revenue, a rapidly expanding CPU franchise, a credible GPU roadmap, major anchor customers, improving software, and a forecast for data center revenue to more than double again in 2024. If Helios ramps successfully, AMD could become the second full scale platform in AI computing, and the size of the market means second place could still be extraordinarily valuable. The bear case is stronger at the stock level. Expectations have moved ahead of current revenue. The most important acceleration is concentrated in a handful of giant customers. Racked scale systems introduce manufacturing and deployment risk. GPU margins are not yet above the corporate average, and the market has shown that a conventional beat is no longer enough. That is the paradox AMD just exposed. The AI bubble's weakest link is not demand, it is time. Investors want the revenue of 2024 today. They want gigawatt announcements to become quarterly sales immediately. They want an emerging software ecosystem to behave like CUDA, a new rack system to ship like a mature product, and 50% growth to continue without interruption. AMD may eventually deliver much of that future. The company's quarter gave us real reasons to believe it can, but the stock's reaction gave us an equally important warning. When the future is already priced as a certainty, even excellent reality can look like failure.